Hello, and thank you for watching this International Financial Reporting for Non-Profit Organisations webcast on NPOs acting on behalf of other entities. This webcast is part of a series that covers some of the key issues in financial reporting that affect non-profit organisations. This session begins by looking at what we mean by NPOs acting on behalf of other entities. Next, we will consider the main issues that NPOs face. We will then look at how these issues are currently addressed in the existing accounting standards, beginning with the international standards, before looking at how some national standard setters have addressed NPO-specific issues. Finally, we will look at the alternative treatments identified in the consultation paper and how you can share your voice and respond to this and other NPO financial reporting issues. NPOs sometimes act on behalf of other entities. They can do this by distributing cash or other assets that have been provided to it by individuals or other organisations. In these arrangements, an NPO can sometimes be an agent, a principal, or both. In its simplest form, an NPO will be acting as an agent where it passes through cash or assets from one entity to another under the instruction of the entity that provides the resources. Sometimes an NPO, acting as an agent, will be paid a fee for administering the distribution. In contrast, an NPO will be acting as a principal where an entity provides cash or assets to it, and the NPO is able to determine what happens to that cash or asset. So what issues does this present for NPOs? It may be a challenge to distinguish between where an NPO acts as an agent for other entities or is acting in its own right. This is important to allow an understanding of an NPO's operating model and the income and expenses for which it is responsible. These will shape an NPO's accountabilities. NPOs can act as a custodian or a trustee of funds or assets for other entities, or they may be responsible for distributing donor funds or grants. This could be because it has a particular expertise or knowledge in a local area where the entity providing the funds does not. In these situations, an NPO will not have the ability to decide how such resources are allocated, but may retain some accountability and have reporting requirements because the funder may deem an NPO distributing the funds to be accountable for those funds, even if they do not directly benefit from them. In addition, an NPO may be entitled to some of the grant itself for services it is delivering or for payments for the administration of the monies. So where an NPO has assets in its care, it may not always be easy to determine the NPO's role, responsibilities, and accountabilities. Arrangements may become particularly complex where there are multiple tiers of entities, partnerships, or consortia. These arrangements may encompass multiple levels of accountability and responsibility. For example, issues may arise in a joint consortia where an NPO may act as a principal in one part of the consortium's activities and agent in another because it is purely administering an activity. Understanding who is responsible for what and an NPO's accountabilities will be easier where there is a formal agreement, setting out the arrangements between the parties. Without an agreement, determining respective roles and responsibilities may be challenging. Subcontractors can sometimes be used to deliver services under individual contractual arrangements. If subcontractors are being used to provide services or distribute funds, this might make it difficult to identify whether there is an agency relationship. An NPO might still be an agent where it only has the responsibility for distribution of the funds, even if it uses a subcontractor to provide these services. Again, it is important to understand the responsibilities and accountabilities of the parties to the arrangement. These issues drive a number of financial reporting issues. Understanding who controls the cash or other assets can be complex, but important to determining whether assets should be recognised. If an NPO is the principal in an arrangement, it is most likely to have the right to control the assets, and the assets should be recognised in the NPO's financial statements. If an NPO is acting as an agent, then it is unlikely that the NPO has the right to control the assets that are in or have been in its care. If so, an NPO is an agent and does not have control, and it should not recognise these assets in its financial statements. Where an NPO controls the assets, funds granted or donated, they should be presented gross in the financial statements. Expenses should not be netted off from any of the contributions received when presented as income and expenditure, or deducted from assets or liabilities in the balance sheet. Where an NPO does not control the assets because it is acting as an agent, the assets coming in and the assets going out should not be included in the NPO's income or expenses or in the balance sheet of the NPO. There may be an argument that financial reporting should cover the full details of all programs, and that this should include both where an NPO is an agent and principal, so that the NPO's responsibilities are clear. NPOs need to be able to fully report on its financial performance and the risks it faces, especially when they are part of a consortium. Donor and grant providers are likely to be interested in the security and fiduciary responsibilities that an NPO might have for funds passing through an NPO or the assets it is holding in custody. Disclosure of the amounts passing through an NPO or assets in custody would provide transparency. A gross reporting approach, similar to when an NPO is acting as a principal, could provide additional transparency. However, additional reporting requirements could increase the reporting burden and potentially audit fees, particularly for smaller NPOs. Let's now look at current international guidance as they relate to agency arrangements. Generally, the guidance is provided by international standards is that an entity is principal if it controls the economic resource in the transaction or transactions. Current international guidance has either a controls approach or a risks and rewards approach to indicate control. Whilst the framework for assessing control differs between the standards, they each provide indicators of control to help make a determination of whether they are agent or principal. Holding a legal title to an asset is not sufficient to recognise it on its balance sheet. What is important is the right to control the economic benefits and the service potential of the asset. The IFRS suite of standards has two standards that offer specific guidance on agent and principal. Under IFRS 10, the IFRS standard on consolidation, there is a requirement for an entity to decide whether an investor is acting as principal or agent, and whether it controls the entity in which it has an interest in. It establishes that where an investor is primarily engaged to act on behalf of other parties, it does not control the investee and is therefore an agent. Under IFRS 15, the IFRS standard on revenue, this requires that revenue is recognised when the recipient is entitled to the economic benefits from the transactions and uses the control concept. IFRS for SMEs takes a risks and rewards approach to control. Although this is not explicit in the standard, the recognition of revenue is assessed using these principles. Section 23 of the standard specifies that in an agency relationship, the agent must recognise the revenue only to the amount of its commission. Similar to IFRS 10, IPSAS 35 on consolidation requires entities to decide whether an investor controls the entity it has an interest in, or whether it is acting as an agent. IPSAS 35 provides guidance for the public sector context. IPSAS 9 on revenue says that an entity is acting as an agent when it does not control the assets. It says that this should be assessed by examining exposures to the significant risks and rewards associated with the sale of goods or the provision of services. To demonstrate these principles, IPSAS 9 and IPSAS 23 on non-exchange revenue establish that amounts collected on behalf of the government, such as taxes, are an agency relationship because the taxes cannot be used by the collecting body. IPSAS 9 and IPSAS 23, as well as the IFRS for SMEs standard, are in the process of being updated. The principles of control in IFRS are specifically included within the considerations for both of these work programs. Let's look at the national level guidance and the differences in jurisdiction. One jurisdiction follows the general approach under IFRS for SMEs and has specific guidance for NPOs that are charities, establishing principles for when a charity would treat transactions as agent or principal. This jurisdiction stipulates that for transactions where a charity is acting as agent, they are not recognised in a charity's accounts because they are not the income of a charity. It also provides the accounting requirements for consortia, indicating that the lead charity is not acting as agent if it is the principal under the contract and is then subcontracting work to third parties. There are also requirements to disclose an analysis of the funds and assets held by an agent and as custodian trustees. A second jurisdiction has guidance similar to the first jurisdiction, with many principles based on international guidance, but is based on national GAAP. It includes provisions on the treatment of transactions, including the treatment of financial intermediaries. Being a principal or agent is dependent on whether an NPO has discretion in the distribution of the money to the beneficiaries. If discretion exists, or if an NPO is a financially related entity, an NPO is principal in the transaction. If it has no discretion, it recognizes an asset and a liability for amounts which have not yet been distributed. Another jurisdiction, also based on national GAAP, provides guidance on when amounts should be recognized gross or net. It adopts a risks and rewards approach to determine when an NPO is principal or agent. It states that revenue should only include gross inflows of economic benefits received on an entity's own account. So there is a consistency in existing guidance that transactions are recognized based on control, but there are differences in how control is assessed. There are some common aspects to the alternatives proposed. All alternatives propose additional NPO-specific examples and guidance that illustrate typical NPO arrangements. Practical guidance for NPO account preparers is intended to assist NPOs in making judgments and reduce the inconsistency in the interpretation of standards. They also propose additional disclosure requirements that provide, for example, transparency of material transactions and balances for assets held on behalf of others that will be beneficial for stakeholders and users. Alternative 1 is based on IFRS standards and uses indicators of control identified in IFRS 10. As outlined, it will be supported by additional guidance, including guidance on how to apply the concepts in an NPO context. Alternative 2 is based on the IFRS for SMEs standard, which effectively adopts a risks and rewards approach, noting that a risks and rewards approach, in many circumstances, is likely to give a similar outcome to that in Alternative 1. As stated earlier, the IFRS for SME standard is currently being reviewed by the International Accounting Standards Board. This review includes the possibility of adopting the approach to control in IFRS 10 and 15. Alternative 3 is based on IPSAS, which also currently supports a risks and rewards approach to revenue. But as noted earlier, the relevant standards are in the process of being updated, and current proposals are for a controls basis that is consistent with IFRS 10. Given the separate programs, it is possible that the full IFRS standards, the IFRS SME standard, and IPSAS will all follow the same approach to control within the lifetime of this project, so that in practice, all approaches may harmonise on Alternative 1. This is your opportunity to shape the future by sharing your voice. Amongst a range of issues covered in the consultation paper, we want your views on NPOs acting on behalf of other entities, including how NPOs on behalf of other entities has been described, the alternative options that have been put forward, the alternative treatment that you favour, and any challenges you might face. Please respond to the consultation paper. The consultation period ends on the 24th of September 2021. Shape the future, share your voice, submit your response.